Good afternoon, ladies and gentlemen. First of all, welcome to the新鴻基FY 2024 annual results analyst briefing. And I would like to thank you all of you for coming under the typhoon. As usual, I'll present an overview of the results and the performance of our businesses, followed by a Q&A section with our senior management. Let's start with the group's financial review. Please note that all figures are in Hong Kong dollars, unless stated otherwise. For the year ended 30th June 2024, the group's underlying profit amounted to 21.7 billion, which decreased by 9% year-on-year. The decrease was primarily attributable to lower property development profit from Hong Kong and the mainland, partly offset by increased profit contribution from property rental and hotel businesses. Including the net effect of revaluation loss of around 2.4 billion on investment properties, the reported profit was 19 billion, a decrease of 20% year-on-year. The underlying earnings per share was down 9% to $7.50, while reported earnings per share was down 20% to $6.57. As for dividend, the Board of Directors has recommended a final dividend of $2.80 per share, a decrease of 24% year-on-year. Together with the interim dividend of 95 cents, total dividend for the full year will be $3.75 per share. Now we come to the profit breakdown by segment. The group's property development profit decreased by 31% to around $8 billion. Mainly due to lower profit margin in Hong Kong and lower sales volume of residential units on the mainland. On rental front, the group's net rental income increased by 3% to around 19 billion, mainly driven by a 1% growth in net rental income in Hong Kong, and there was also an 8% increase in net rental income from the mainland portfolio. There was a recovery in inbound tourism, which offers supports to the group's hotel business. An operating profit of 650 million was recorded from the group's hotel business, significantly increased from 161 million in last financial year. Profit from other businesses also increased by 2% to around 4.9 billion. Altogether, the group's total operating profit for FY 2024 was down 7% to around 32.4 billion. On financial position, as at 30th June 2024, the group's net debt was 111 billion. The net gearing ratio was 18.3%, down from 21.2% as at the end of December last year. Interest coverage for the past 12 months was around 4.6 times, compared to 6.8 times a year ago, mainly due to higher interest expenses. The group will continue with prudent financial management. Ongoing measures of cash flow management, including strict control on construction capex and strengthening of our recurring income from property investment portfolio and non-property businesses. We will also strive to achieve fast asset turnover for property development business. We expect to see the net gearing ratio to drop further by end of next financial year, with over 28 billion to be received by June next year. To diversify funding sources and achieve a better alignment of the group's RMB-denominated assets and liabilities, the group has been ramping up the use of RMB-denominated borrowings. As at the end of June 2024, about 46% of the group's total borrowing were either fixed-rate debt or RMB floating-rate debts. The group's debt maturity profile were also well staggered. The group is one of the best-rated developers in Hong Kong, holding an A+ rating with stable outlook from S&P and A1 rating with negative outlook from Moody's. The group maintains a sizable recurrent income base from its rental portfolio and non-property businesses. For this financial year, this recurrent income base was just 1.6% below the peak level in FY 2019. Now we come to the performance of different business segments. As of end of June 2024, the group's total land bank in Hong Kong was about 58 million square feet of attributable GFA, comprising 38 million square feet of completed properties and around 19.6 million square feet of properties under development. Among the completed properties, retail portfolio accounted for 33%, while offices accounted for 29% of the total. For property under development, about 13 million square feet were residential property under development for sales. These developments are expected to be completed in phases over the next 6 to 7 years. During the financial year, the group added 3 residential sites with total GFA of about 1.5 million square feet through lease modification. We also add 2 sites totaling 465,000 square feet of GFA after the end of financial years. The group will continue to adhere to its prudent financial discipline, including a selective approach in land banking replenishment. Regarding land resumption, the group's land plots in Kudong North, Fanling North, NDA were resumed by the Hong Kong government, with cash compensations of about 1.9 billion already recognized in this financial year. Another batch of land lots in Hong Shui Kiu, Ha Chin NDA will be resumed, and the compensation of around 2.7 billion will be recognized in the next financial year. Let's move on to the property development business in Hong Kong. For the financial year, the group recognized that property sale in Hong Kong increased at 3.7% year-on-year to 24.8 billion, mainly derived from Novoland, University Hill, Silicon Hill, and Grand Yoho. Development profit decreased at 23% to over 6.5 billion, mainly due to lower development margin. During this financial year, about 2.5 million square feet of residential gross floor area was completed. Contracted sales not yet recognized amounted to around 25 billion, of which around 19.6 billion is expected to be recognized in the next financial year. Hong Kong residential market became active following the withdrawal of cooling measure in February this year, but has softened in recent months as interest rate remains high. During the financial year, we achieved around 25.6 billion of contracted sales in Hong Kong, of which 35% or 8.9 billion were from the sale of completed stocks, including Dynasty Courts. This map shows our new project to be launched in the next 9 months, which include a diverse mix of residential projects across Hong Kong to appeal to different home buyers. There are mass market projects such as Sai Sha near Ma On Shan, Yoho West and the Yoho Hub in Yuen Long. As for luxury projects, in addition to the recently tendered Victoria Harbour 2 in North Point, we will also launch Kulin Sky in Kai Tak. Furthermore, we will continue to put up for sale the unsold completed residential units and some non-core properties. We will be looking at our Hong Kong rental portfolio. During the financial year, the group's rental portfolio in Hong Kong continue to achieve modest increase in gross rental income of 1.2% year-on-year to about 18 billion. Overall average occupancy remains stable at around 92%. Higher gross rental income from retail and service apartment portfolios offset the decrease in office rental income. The group's retail rental income accounted for about 52% of total gross rental income in Hong Kong. We have adopted a proactive approach to strengthen the competitive edge of our malls. That includes ongoing asset and service enhancement and refining trade and tenant mix to enhance shoppers' experience. These efforts help the group to achieve stable occupancy of around 94%. Our major malls enjoy strong connectivity. They are located along the railway lines and are linked to the surroundings by covered footbridges. Not only do we partner with business units and tenants in launching promotions, we also collaborated with market players from different sectors. A number of our malls have introduced pet and family facilities by refurbishing their outdoor areas. For example, part of the open space in the new town plaza will be reconfigured into a chill park. The Points, our integrated loyalty program, helps our mall drive footfall and enhance shopper experience. The program has also leveraged the group's extensive retail network and hotel footprint to strengthen membership recruitment. The Point will launch a new function soon, allowing special members to pre-book the EV charging service. The new instant point earn function has been extended to about 60% of tenants in the group's major mall. The Points also collaborates with the Go Royal, the hotel's loyalty program, to drive synergy. Moving on to the office rental performance. Despite the challenging market, the group's quality office portfolio achieved an average occupancy of about 91%. Our portfolio benefited from the flight to quality trend. We differentiate our portfolio by premium building quality and professional management services. In particular, we adhere to high green building standards that meets the ESG goal of our tenants. We will continue to upgrade our major existing buildings. In the near term, some properties have already opened recently and strengthened our recurrent income base. YOHO Mix and YOHO Plus in Yuen Long opened in June this year. These new malls introduce popular brands and restaurants new to Hong Kong and pet and family-friendly spaces. They are linked to our flagship YOHO Mall by footbridges, creating the largest retail cluster in the Northwest New Territories. In the near to medium term, the group's recurrent income base will be further expanded as major new investment property come on stream. They will include the mall beneath the Millennium in Kwun Tong, high-speed rail terminus development, an Artist Square project in West Kowloon, and a commercial project in Mong Kok. A highlight in the pipeline will be the high-speed rail West Kowloon terminus development, whose office portion has been named the International Gateway Center, IGC. IGC comprises 2 sets of twin block Grade A office towers and has attained the highest sustainability ratings. An entire block has been taken up by UBS as its regional headquarters. The group also exchanged the green lease with UBS to demonstrate our commitment in sustainability. The project will be ready for handover from early 2026 and is expected to create synergy with our other properties in West Kowloon, including the Asia Square Tower project under construction and ICC cluster. Now let's move on to our property business on the mainland. As at the end of June 2024, the group's total land bank on the mainland was about 67 million square feet of GFA on attributable basis, comprising about 21 million square feet of completed properties and 46 million square feet of properties under development. Among the completed properties, 43% of them were shopping centers, and 38% of them were premium office. Now let's focus on our property development business on the mainland. During the financial year, the group's recognized property sale on the mainland decreased by 49% year-on-year to about 2.7 billion, mainly due to lower sales volume. Development profit was also lower at about 1.3 billion, with satisfactory development margin. As at the end of June 2024, the unrecognized contracted sales amounted to 12.6 billion RMB. About 8 billion RMB will be recognized in the next financial year. In FY 2024, the group achieved the contracted sales of over 11 billion RMB on the mainland, mainly from the sale of residential units at Shanghai Arch and Hangzhou IFC. In the next 9 months, 4 projects with a total attributable GFA of about 930,000 square feet will be launched. You may refer to the table here for details. Now let's take a look at our mainland rental portfolio. During the financial year, the group's gross rental income from mainland rental portfolio increased by almost 8% year-on-year to about 6.3 billion, or up 11.6% in RMB terms. The major driver was the retail portfolio, whose rental income increased over 16% in RMB terms. Also, incremental contribution from Nanjing IFC Mall and Shanghai 3 ITC Tower A also contributed to the increase in gross rental income. The group's major mall on the mainland continued to maintain high occupancy with positive rental reversion. The portfolio rise above the competition with synergy within our large-scale integrated project and proactive management approach. Shanghai IFC Mall is a must-visit luxury destination and maintain high occupancy. As for the office market, although the environment remains challenging, the group's Grade A offices at Shanghai IFC, Shanghai ICC, and the first two phases of ITC achieved a satisfactory occupancy. 3 ITC Tower A is ramping up with 70% committed occupancy. We have extended our success from Shanghai to Nanjing recently. The 1 million square feet Nanjing IFC Mall hosts its grand opening in July this year and achieved high occupancy already. It houses duplex luxury flagships and new concept stores together with popular restaurants. 3 ITC in Shanghai is a highlight in the pipeline, which will further expand the group's rental portfolio on the mainland upon full completions. Tower A office was completed in FY23, while several other parts are under construction and are scheduled for completion from 2025 onwards. They include the Tower B, the 370-meter tall office skyscraper, the flagship mall ITC Maison, the hotel and the Shanghai ITC. Both Tower A and Tower B meet world-class green specifications under the LEED and WELL certification program. Moving on to our hotel business. The group's hotels in Hong Kong achieved a notable recovery, although the return of inbound tourists has been slower than expected. Room rate and occupancy continue to improve. On the mainland, Ritz-Carlton Shanghai Pudong achieved a record high in both average room rates and RevPAR. As for new hotel, Four Seasons Hotel Suzhou opened in December last year. As a result, operating profit of the hotel segment reached 650 million, up significantly from 161 million the same period last year. Let's turn to our ESG initiative. The group will, starting from this financial year, disclose its scope-free emissions for better transparency. We are committed to obtain LEED Gold or Platinum rating for our new major commercial properties. As mentioned in the previous slide, we have exchanged a green lease with an anchor tenant of the IGC. The group is committed to using renewable energy. We installed a super fast EV charger in our malls and purchased electric construction equipment to reduce emissions. In collaboration with a bank, our construction arm, Sandfield, launched Hong Kong's first ESG-linked supplier payment scheme this year, which allows suppliers and subcontractors meeting sustainability targets to enjoy early payments for goods and services. The group uses its resources to make Hong Kong a better place to live and work in. Out of the initiative, we lent a site in Yuen Long to the government for the construction of one of the city's first light public housing estate. It will start taking in residents around first quarter 2025. During the 2024 Paris Olympic Games, we utilized our extensive shopping mall network to promote the Olympic spirit in Hong Kong. We also continue to promote reading and support a wide range of sport for charity initiatives. For more information about our latest ESG performance, please refer to the appendix of this PowerPoint or our website. Now, I will discuss the market and business prospects. In Hong Kong, the economy is expected to register modest growth in the near term, despite a challenging external environment. Potential interest rate cuts should further benefit the housing market, while rising home rents supported by solid housing demand. Relentless efforts by the government to foster a mega event economy and the recovery of passenger flight capacity will support the revival of inbound tourism. On the mainland, policies in cultivating new quality productive forces, advancing high standard opening up, and unleashing domestic demand will render further support to the structural transformation and steady economic growth. Supportive measures should help steer the property sector towards a more sustainable path over the medium term. As for our business prospect, the groups attach importance to cash flow management and will continue to adhere to prudent financial discipline, where we strictly control capital expenditure. The overall construction capex is expected to decrease meaningfully in the next few financial years. We will continue to strengthening recurrent income from property investment portfolio and non-property businesses, and working on enhancing the competitiveness of our portfolio. We aim to achieve high asset turnover for our property development business, including the disposal of non-core properties. With new major projects in Hong Kong and on the mainland coming on stream, we aim to achieve long-term growth in our recurrent income. For the property investment portfolio, one of our key strategies is to strengthen its competitiveness to enhance service quality, in addition to leveraging the strength of its sizable quality portfolio in prime location. Over the next few years, several of the group's new developments are coming on stream, creating new sources of recurrent revenue. The shopping mall underneath the Minality and the high-speed rail West Kowloon Terminus development in Hong Kong, as well as 3 ITC in Shanghai, will help contribute to the group's recurrent income upon their gradual completion. From property development business, the group will continue to capitalize on its strong reputation for delivering high-quality properties to achieve high asset turnover. We will continue to launch new residential projects for sale when ready and put up for sale unsold completed residential units and some non-core properties. Finally, I would like to conclude my presentation with the following message extracted from the chairman's statement. Over the past half-century, the group has been shaping Hong Kong's cityscape with iconic landmark developments, which have built its history and long-running reputation for quality. The group's customer-centric culture has earned trust and long-term relationship with tenants and customers. Adhere to prudent financial discipline. The group have achieved sound performance and resilience in weathering various economic downturns. Moving forward, the group will uphold its unwavering commitment to quality, flexibility in moving with the times, and prudent financial discipline. Supported by its solid foundation, including time-tested business strategies and strong execution teams, the group strongly believes it will rise above challenges and achieve long-term growth by continuing to build quality properties to meet public aspiration for a healthy and environmentally friendly community. This is the end of my presentation. Thank you.
Thank you, Miriam. Let me first introduce the panel members. Starting from your left, Mr. Alan Fung, Executive Director. Mr. Christopher Kwok, Executive Director. Mr. Victor Loy, Deputy Managing Director. Chairman and Managing Director, Mr. Raymond Kwok. Mr. Mike Wong, Deputy Managing Director. Mr. Adam Kwok, Executive Director. Mr. Eric Tong, Executive Director. And Mr. Frederick Lee, Group Chief Accountant. May I now invite Chairman and Managing Director, Mr. Raymond Kwok, to share with us the highlights of today's results announcement. Mr. Kwok, please.
Yeah, thank you for attending today's session. We'll try to end the session before the typhoon number 8. That signal is hoisted, okay? Thank you for attending in spite of the weather. During the year under review, the group continued to deliver resilient performance despite the challenging external economic and operating environment. Such performance was supported by the group's prudent financial discipline, extensive experience gained over the years, and strong execution ability of its management team. The group's premium properties and services, as well as its reputable brand, also serves as a backbone of our performance. The group continued to launch new projects for sale when ready. During the year, the group's contracted sales in Hong Kong and on the mainland amounted to about 37.5 billion. New launches in Hong Kong included Yoho West Phase 1, the Yoho Hub 2 in Yuen Long, and Cullinan Harbour Phase 1 in Kai Tak, as well as Dynasty Court in mid-levels and other completed projects. All of these projects received positive market responses. On the mainland, projects offered for sale include Phase 3 of Shanghai Arch and the third batch of residences at the River East part of Hangzhou IFC. The sales response for both projects was very encouraging. For a quick update, after the financial year, the group launched Victoria Harbour 2 in North Point for sale by tender just last week. Several projects in Hong Kong will be put on the market over the next 10 months. They include, for example, the first phase of Cullinan Sky in Kai Tak, a new block at the Yoho Hub 2 in Yuen Long, a joint venture project on Prince Edward Road West in Ho Man Tin, the second phase of Yoho West, and the first phase of the Sai Sha project near Ma On Shan. On the mainland, the group plans to launch new batches of its joint venture developments. These include the new phase of the Villas project, Lake Genève in Suzhou, and new batches at Hangzhou IFC and Oriental Bund in Foshan. For the group's property investment portfolio, its overall occupancy was satisfactory, thanks to continuous efforts to make the portfolio more competitive. In addition to having premium building quality and professional property management services, the group's office buildings are designed with high green building standards that align with tenants' ESG goals. They continue to attract multinationals and domestic corporations. The group's mega project atop the high-speed rail West Kowloon terminus is set to become one of the most sustainable and eco-friendly buildings in the world. Its office portion, called the International Gateway Center, the IGC, has secured global financial institution, UBS, as a tenant for an entire block to house its regional headquarters. This landmark project, plus other new developments coming on stream, will bring additional rental income and steady cash flow to the group starting from the next 1 to 2 years. To cope with the challenging operating environment, the group continues to enhance the competitive edge of its malls. Apart from upgrading its properties and services, we regularly refine the tenant mix of our malls and have added more pet and family-friendly facilities in outdoor areas. The loyalty program of our malls, i.e. The Point, continues to expand its customer base and launch new initiatives to bring greater convenience to customers. Over the next few months, the group plans to double the number of EV superchargers at its malls, and the pre-booking service will be launched soon for our select Point members who want to use our EV superchargers. On the mainland, the group has replicated the success of Shanghai IFC Mall in Nanjing with the recent opening of Nanjing IFC Mall. As a third iteration of our signature IFC brand, Nanjing IFC Mall houses an array of prestigious high-end brands. Some are Asia and global flagship stores. It is quickly becoming a popular destination and a new landmark in Nanjing. Separately, the remaining portions at 3 ITC in Shanghai, including Tower B, Office Tower, a Mega Mall ITC Maisons, and the Andaz Shanghai IFC Hotel, are scheduled for completion from 2025 onwards. These additions are expected to contribute to the group's sizable recurring income base when they are completed. The group has exercised prudent financial discipline in land bank replenishment. During the year, the group added 3 residential sites to our land bank in Hong Kong through lease modifications, with a total GFA of about 1.5 million square feet. Moreover, the group is expected to receive cash compensation of about 1.9 billion for the government's resumption of our land lots in Kudong North and Fanling North new development area. Another batch of land lots in Hong Shui Kiu, Ha Chun new development area has also been resumed, with compensation of about 2.7 billion. In addition, the group is applying for land exchange for other lots in the Hong Shui Kiu area. In keeping with our belief in building homes with heart, the group is dedicated to developing a harmonious and sustainable community for all. The large-scale project in Saisha will not only provide premium residence, but also a sports and commercial complex covering a site area of 1.3 million square feet called Go Park Saisha. Infrastructure in the surrounding area has been upgraded to benefit all residents who live nearby. By blending green lifestyle with nature, the project is set to become a most enjoyable and dynamic community. The resolution adopted at the 3rd plenary session of the 20th CPC Central Committee affirmed that Hong Kong should leverage the strengths of one country, 2 systems to enhance its status as an international financial, shipping, and trade center. It also supported Hong Kong's drive to build itself into an international hub for high-caliber talent. Such efforts, along with the government's initiatives to attract businesses, investment, and talent, are expected to strengthen Hong Kong's competitive edge. Furthermore, a potential interest rate cut should benefit the housing market. The group will uphold its prudent financial discipline and maintain substantial recurrent income from its rental portfolio and non-property businesses. It will leverage its strong brand. It will focus on high asset turnover in its property development business, while staying responsive to market conditions. Without compromising on quality, the group will continue to strictly control the overall construction capex. Riding on its time-tested strategies and a strong execution team, the group has built a strong foundation over the years. Going forward, the group will continue to develop quality properties that help to build a healthy, eco-friendly community for the public. The group will also strive to achieve sustainable growth. Thank you. Thank you very much. Thank you.
Thank you, Mr. Kwok. So we now open the floor for questions. So before posing your questions, could you tell us your name and the company you represent? So may I have the first question, please? So the gentleman in the first row, please.
Yeah, thank you, management. This is Mark Leung from UBS. So I got about 4 questions. I think the first question is regarding on the market outlook. So if the rate cut is around the corner, so what's our residential market outlook in terms of both prices and volume? And what is our sales targets for Hong Kong and China for next fiscal year? I think that's the first questions. And the second question is regarding on the margin side. So the booking margin for this fiscal year is about 26%. But I think in the result announcement, we continue to highlight asset turnover. cash flow management. So going forward, how should we prioritize the margin and volume for the new project launches? I think that's the second question. And the third question is, we also mentioned we are going to be CapEx discipline, control the construction CapEx. But at the same time, we do acquire several land sites, free farmland conversion, and 2 residential land site acquisition. So what's our thoughts on that one? And lastly is on the Singapore investment properties. Just want to check with management, why don't we exercise the option to buy the Singapore Iron Orchard Mall? Thank you very much.
Yes, on the first 2 questions, on the residential market, the relaxation of cooling measure on stamp duties have stimulated our primary market earlier this year. Although momentum is a bit slowing down in recent months, I think this is quite normal after a strong rebound on volume. We all know that both the employment and immigration policies of the government are very well received, backed by the influx of talents and students. The residential leasing market has been very active over the months, and actually, we can see from the government rental index that the rents are rising quite rapidly, and the upward trend continues. I think for most of the talents, they will consider buying a property and becoming homeowners after 2 to 3 years of adaptation to our society. And even in the local market, as the rents are rising and we are expecting that interest rate, there may be an interest rate reduction later this year, that will also induce a lot of renters consider to become home buyers too. So for the next 12 months, I think the market will be very active with an increase in transaction volume. But since we are still in the course of economic recovery, I think the prices may just rise modestly in the range of 5 to 10%. And for the next 9 to 10 months, we should have a number of projects to be launched, namely Victoria Harbour, Phase 2, which we are doing now, and also followed by the second block of Yoho Hub 2, together with our JV venture in Prince Edward Road, and also our Cullinan Sky project connected with the Kai Tak MTR station. At the end of the year, that will be Phase 2 of Yoho West. And not forgetting our mega project, Saisa, the Phase 1A will be marketed in early next year. We have achieved a total sales of over 25 billion, which is exceeding our target in last year. And we are very confident that we can conclude a similar, a better sales in this financial year. And on margin positioning, over the years, I think you agree that we can always strike a balance between volume and margin. And for the mass project, we are usually aiming for a quicker asset turnover, like the Yoho West project, which we have sold over 1,050 units within 20 days in the beginning of this year. And recently, even the units of Lovo Land are doing well. And you know our cost of these 2 projects, and I think we can have a good and reasonable margin in future. Even for a luxury project like Victoria Harbour Phase 2, which we are selling through a number of tenders, actually we have a few transactions with an average price range of $30,000 to $40,000 per square foot, which can also deliver good profit for us. And in the last quarter, I think you are aware that we have sold a number of units in Dynasty Court, and this is a non-core investment properties. We have a very low historical cost, and these units are going to deliver handsome profit for us. Thank you.
I think on the question about the CapEx discipline, right? I think we are buying land that we're confident of selling the end units, right? And also, we are buying land that we predict the profit margin will be very reasonable, yeah. And in the primary market, the property prices have fallen to 2017 level. I think if government is prepared to offer more reasonable premium, I think this could be a good time to accept, provided that we are confident of selling the end units, yeah. And regarding your question about capex, right? I think we would be developing properties. For example, we will be developing investment properties that we feel confident of, yeah. If we are not confident of the lettability, we're going to slow down on the investment capex. But anyway, I think buying land, we feel at the right time, when we are confident about the end sales, I think it's a good time, yeah. And government has realized that they should be more flexible now, yeah. On the Singapore Iron Orchard, I think we have a very good working relationship with Capital Land, and I think Capital Land is transferring the 50% to their listed fellow subsidiary. And I think we work well with them, and then I think we need a strong local partner to operate in Singapore, given that our company is not based in Singapore. And we have, Capital Land and us have both agreed that we should continue to invest to make sure that a mall would be the best mall, best luxury mall in Singapore, yeah. So we work well together with Capital Land, and we are confident of the future of the mall, yeah. Thank you.
Thank you, Mr. Kwok. So can I have the second question? So the gentleman in the front row, please. Thank you.
Thank you. Griffin Chan from Citi. So I have 5 questions. The first one will be on dividend and capital allocation. So will there be any change in your dividend policy in 2025? And will you consider for more active capital recycling from the non-core asset disposal? And what is the capital allocation strategies between deleveraging, share buyback, as well as on the land banking? So this is the first one. The second one will be on gearing. So are you comfortable with the current gearing level and debt level? So what is the optimum level on the RMB denominated debt as a percentage of the total debt? And we will consider to be adding more onshore financing in China. So this is the second one. The third one will be on the land banking strategies in Hong Kong. So what is the group land banking strategies in Hong Kong, given the land cost, home price is falling, as well as the sales is weak? And what is the expected margin and the minimum return for the new land banking in Hong Kong? And the next one, the fourth one, will be on the China land banking. So what is the land banking plan for China? Will you consider to bottom fish some of the commercial properties in Hong Kong or in China? Or even will you consider to buy out any project stake from your partner from the project in China? And the last one will be on industrial building conversion. Will you be consider developing or converting more of the industrial building into data center? For example, say for Sunvision, especially for those in the northern metropolises. Thank you.
On the last question, Ellen, can you respond to that?
Yes. I'll take the last question first. I mean, Sunvision, we have a very robust pipeline in Tseung Kwan O. It's a multi-phase project. Our phase 1 just opened, and we still have a lot of, and we like that location very, very much because it is very high electricity, very dense in fiber. So we're going to invest quite heavily in that. Obviously, we'll continue to evaluate other opportunities. I think there's a misconception in the market that there is not enough space for data centers. Actually, there is actually a lot of buildings, a lot of space which can be turned into data centers, just that they might not be great data centers. So we're continuing evaluating that, but I think we will particularly focus on our Tseung Kwan O asset because this is a very, very good site and has very dense electricity and has all the infrastructure that can support the development of AI data centers in the future.
Yeah, and also for for Zhongguan I think we've incurred the land cost, right? There are still a lot of, we still have phase 2 to build, right?
Phase 2 and phase 3.
Yeah. So we have enough land bank for the foreseeable future. But anyway, on the total supply of land for data centers, they're really plenty in Kwaichong and Jinwan, right?
Totally.
Yeah.
There's actually quite a oversupply.
But anyway, I think for Sunny Vision, we also need to control our leverage a bit, right? So I think we've incurred a lot of the capex for the land and construction, right? Yeah. So we would want to make sure that the capital is the productivity of the capital is high. Yeah. Adam, can you answer on the China land banking?
Yep. Thank you. On the China land bank, I think 3 things. Number 1 is, as our chairman was saying, we have to be very agile, and we have to only build if the market has demand. And so even though we have, for example, 45 million square feet under development, we'll of course only build it if there's demand, and if not, we'll phase it out. So that's part of our strategy to control capex and also being agile to adapt to market demands. And number 2 is that, even with the core portfolio we're building and with the completion schedule we give you, our IP is going to grow from 19 million right now to 30 million in the next 3 years. That includes Shanghai ITC Phase 3, Hangzhou IFC, Suzhou, Guangzhou, etc. So I think the point is we're very focused on execution because our IP alone is going to grow 50%, and it's not an easy market to lease it out and sell out. And I think finally the third strategy and third point is on sales, on property development sales. We are very focused on monetizing and asset turnover sales. You will see we've achieved 11 billion from fiscal year in China from this past fiscal year, mostly from Shanghai Arch and also some from Hangzhou IFC. And you'll see that we also have ample sales resource from existing stock and also coming new launches in the coming year that we are focused on asset turning over and selling it. So I think the summary of all that is, we'll build it out by phases according to market demand. We will also, raise our focus on just executing on our investment portfolio growth and also our residential sales. And on partners and buying the stake, of course, we're open to it if the price is right and the partner is willing, right? And especially if we run it too. So, you should talk to our partners and convince them.
Okay, let me pick up the land bank strategy in Hong Kong. I think probably as our chairman mentioned earlier on, we are sticking to our very prudent and strict financial discipline when considering to acquire new plots of land. Probably our chairman has just mentioned 3 plots of land have been bought during the financial year. But after the financial year, we have bought 2 more pieces of land, one through public tender and one through conversion of our land. Go back to the 3 early on projects are all conversion from land to residential land that we consider the location, the locality will have synergy to our project. Clustering to Yoho Town for the first project in Yulong, and Sha Tin is a very unique area where the demand is strong, location is good, very close to the Taiwan station, and the supply is not oversupply. The first 3 lots and the following 2 plots of land, Sha Tin again, the Still Living one is not a big one, but it's a very unique plot of land next to the City 1 MTR station. We're very confident we can build a very decent project, could acquire a decent margin in due course. And the other one, the small one, is in Fang Ling NDA, which is pretty a long-term project, but we are confident with a very low conversion price, which is less than $2,000 per square foot. We're confident we can, in due course, develop a good project in that new development area and can fetch a decent margin. But by the same token, we are adopting the same principle to acquire, or probably through conversion of land to residential land in very selective area at the we consider very good price. We'll buy it at the right time. This is our strategy.
Yeah. I think to add to what Mike has said, right, I think a lot of our senior team members have gone through the 98 to 2003 cycle, yeah. So we feel we have the judgment to decide when and where to buy, yeah. And I think in any case, I think the Hong Kong population will increase over time, and there will be also need for private housing. On the dividend policy, I think our dividend policy is to pay 40 to 50% of the underlying profits. So that has been our policy. Last year, the payout was 60% because I think earlier on, before 2003, we indicated to the market that we would be the absolute dividend per share would stay. But I think now we will go back to the prudent principle of paying 40 to 50% underlying profit. I think we need to make sure that the company gearing will not go out of our comfort level. In terms of use of cash, I think, of course, we'll be paying dividend. We will not consider buying back shares. I think we believe that in this current market, we need to be very agile and flexible, and therefore we'll try to keep a low gearing ratio so that we maintain the flexibility to buy in the market when the market is further depressed. At the same time, as Victor said, we are selling more non-core properties that are yielding a low return, so that we can recycle the capital. Yeah. On the RMB loan, I think we have a lot of RMB assets. So the RMB loan is mainly we're just trying to borrow enough to cover the our investment exposure in RMB, because I think it's more prudent to match the asset and the liability. Yeah. Thank you. Yeah. And also, of course, interest rate in China is lower. Yeah. Thank you. Yeah.
Thank you. So could I have the third question? So the gentleman in the second row, please.
Thank you, management. This is Carl Chan from JP Morgan. I have 4 questions on the commercial side. The first 2 questions are about retail. So for the first question, it's so recently the duty-free limit for the mainland Chinese tourists has been lifted. How do you see the impact on our group's tenant sales performance? And do you expect there may be any other policy to further support the tourism sector in Hong Kong? So that's my first question. And then for my second question is, in Hong Kong, how have the retail sales been like among our malls? Because most recently we saw from the Hong Kong overall number is trending negative. So just curious to see how our tenant sales are doing. If possible, do you have like the same-store tenant sales figure in the past half year? And then in terms of rental reversion, how are we seeing so far? And then for next year, do you have any outlook on the rental reversion? And given the fact that retail sales are still mostly quite soft, do you see any risk of a negative rental reversion for next year? And because right now we are also talking a lot about the consumption leakage to Shenzhen, also some changes in the consumption behavior. How do you see what is our strategy to cope with these challenges? So this would be my 2 questions on the retail side. And then on the office side, I'm just curious to know about the rental reversion in the past year. What's your outlook for next year? And then what kind of strategy we are doing in order to maintain a high occupancy in the Hong Kong office market? And then my last question is very simple. 2 numbers. One is how is the occupancy trend in Hong Kong IFC? And the second is for the IGC, International Gateway Center in West Kowloon. Can you give us some colors on the pre-leasing status? So that's my 4 questions. Thank you.
Sure. I think I'll answer the 2 questions on the retail market. I think so the duty-free limit on mainland Chinese tourists was just lifted on July 1st. And so I think the full impact has yet to be seen. But during the summer, we have noticed that there's an uptrend of mainland tourists visiting our shopping malls. The public statistics reflect this, and so does our loyalty program, because we see an intuition contribution from mainland tourists who are joining our loyalty program. So among our malls, I think some of the malls that are located in more tourist favorite districts, like the IFC MoCo, they have registered growth in tenant sales. But also for our regional malls, I think the sales have remained resilient. And I think going forward, I think the government is trying very hard to bring more events and to promote the tourism everywhere in Hong Kong. And I think that's we fully welcome that, and we try to find different ways to work with them so that these events can also be spread and promoted among our malls. So for example, I think early in this summer, we hosted a number of promotional activities in our malls that revolve around the Paris Olympic Games. And it's actually been able to bring more traffic to our malls during after dinner hours, because that was one of the biggest pain points for the post-COVID recovery for Hong Kong. So we'll continue to do more events at our shopping malls as well. And in terms of the sales and rent reversion numbers, so for this recent financial year, I think our retail sales overall has been resilient compared to the previous years. Of course, I think there's definitely a change in the spending pattern among locals and tourists. But so far, our occupancy cost is healthy. And then we also see, in terms of rental income, we also see a moderate increase as well. In terms of the outbound shopping, I think it's a natural occurrence given the borders have opened. And for us, I think we just have to be proactive in managing our retail portfolio. So as the chairman has said just now, we'll continue to bring in more new entertainment and dining options to our malls, to introduce more pet and family-friendly facilities, and make better use of outdoor areas as well. And we'll continue to carry out asset enhancement works. Most recent focus being on increasing the EV charging network, because we feel that has been able to bring us more car owners to our shopping malls, and usually they spend more compared to non-car owners. And also we also continue to invest in our loyalty program. So in the coming 6 months, we'll launch a new instant earn service, so members can earn points immediately after purchase without having to spend extra effort to upload receipts. So hopefully that will encourage more spending in our malls, and we hope that for customers, they will even if they're shopping for the same brand, they will choose our malls over our competitors. So that will be our target. Thank you.
On the office leasing market, recently we have seen an increase on inquiries and inspection in CBD area as the flight to quality continue to prevail, and the decentralization trend also induce a lot of office users seeking the opportunity to upgrade the offices in terms of location and building facilities, taking the advantage of a more attractive rental compared with 2 years ago. So our 2 buildings, both 1 and 2 IFC, are benefited as it is still the most sought-after location for renowned financial institutions. Both buildings are now 95% occupied. And for ICC, it is also benefited by the West Kowloon cultural area and also the high-speed rail. It is over 90% occupied. We have been very successful to retain our tenants in last financial year. For our flagship development, 1 and 2 IFC and also ICC, we have already renewed over 70% of tenancy to be expired in the next 12 months. Whereas for other buildings, like those buildings in Kwun Tong and Wan Chai Causeway Bay, as most of the tenants are belonging to multi-sectors, they tend to renew their leases when it is closer to the expiry. But having said that, we have retained over 80% of our tenants in this financial year. Overall, for our office portfolio, we allow an average of 90% occupied. And we have recorded a mild negative reversion of mid-single digit in the last financial year. On the ITC development, it is situated permanently atop the high-speed rail link and connected with the Airport Express line and also 3 MTR lines, and have superb connectivity to Hong Kong and major cities in mainland and other parts of the world. And it is also staying along with our mature development ICC, 2 luxury hotels, and also the RT Square Tower under construction that will form a permanent hub on commerce, culture, retail, and entertainment. And on the leasing side, apart from UBS, we have a number of renowned companies under very serious negotiation. I think there will be some noticeable transaction to be announced very soon. It will confirm our position as a wealth and asset center in the GBA area. Thank you.
Thank you. So could I have the next question? So the gentleman in the shirt.
Hi, this is Raymond Liu from HSBC. Thank you, management, for taking my questions. So I got 4 quick questions. The first one is related to the Hong Kong housing market. So as management mentioned, like there's a bit slowdown in terms of housing market, and also we see that the government is trying to support the housing market to try to stabilize it. Would the management expect there will be more supportive measures from the government to help the housing market to further stabilize in the next 6 to 12 months' time? So the next question will be related to the rental portfolios. So if you look at the portfolios, like in the coming year's time, we see several major projects will complete, like the Nanjing IFC, the ITC project in Shanghai, as well as the West Kowloon project in West Kowloon. So can the management share with us the approximate like incremental rental contribution that could come from these types of projects? And follow on this, just on 3rd questions. Can management share some of the update on the pre-leasing process of the ITC shopping mall, the Maison in Shanghai? And lastly, like if you look at the recent comment on in terms of contracted sales, in terms of revenues, would the management confident to say that like the earnings of the companies have bottomed in 2024, and we should see some more improvement going onwards? Thank you.
Christopher, can you answer the question on Maison, Shanghai, right?
Sure. So the ITC Maison project is our biggest project to date, and it will be a mix. For the mall section, it will feature a mix of top-notch brands across various trades and lifestyle categories. So far, the pre-leasing has gone smoothly, and we've seen strong interest from a number of our luxury tenants who are interested in setting up flagship stores at the ITC project. The plan is to open the mall by phases from 2025 onwards, and I think so far the past success that we have enjoyed and continue to enjoy at the Shanghai IFC has really given us dividends. So our team is working very hard to create a new project that incorporates all the learnings from our past projects and make it the best project we can deliver. And so far, I think maybe I can also comment on the Nanjing project. Nanjing IFC recently formally opened this summer. Is also seen encouraging growth, and I think we've been able to establish good relationships with the luxury tenants, and we hope to be able to kind of bring them onto other projects and also engage them in special marketing promotion events so that we can bring more customers to our shopping malls. Yeah.
Yes, on the government policy, I think our government will continue to boost our economy. That is beneficial to the sentiment and confidence of the market. And we are also expecting that there will be an interest rate reduction later this year, and that will induce a lot of renters becoming home buyers. I think the government can also consider to include residential properties as a valid investment for immigration to Hong Kong. That will be helpful to our market too. Thank you.
Yeah, I think for the housing market and even for the office take-up, right, hopefully there will be more mainland companies and mainland talents coming to Hong Kong, right? If a lot of the mainland medium-sized enterprise want to go overseas, I think most likely they will come through Hong Kong, right? So Hong Kong should benefit, yeah. On the question about the rental portfolio, I think we are growing our rental portfolio, and I think the rental, the investment properties location at the moment now we are building is slightly better than our existing portfolio. So you can assume that our rental income would go up per square foot wise. I mean, the new ones would be better in terms of dollar per square foot, yeah, because given the location is better and also given that the design is better too. On the question about whether earnings are bottomed, I think it all depends on the development profits in Hong Kong and in China. I think we are feeling very comfortable about the recurring rental income. But as to the development profits, I think, of course, personally, I think the development profits should go up, given that we are selling more volumes, right? But of course, I think in terms of the market environment over the next 2 years, there's so much uncertainty regarding the geopolitics, about the politics in the U.S., about the U.S.-China Cold War. So there are a lot of unpredictable. But I think Hong Kong has already gone through four years of recession, right? So and our property prices, residential property prices, have gone to 2017 level. So I think development profits should stabilize at this level. But I think it all depends on whether the property sales market can sustain. But I'm confident in the long term, yeah.
So thank you. We'll have the last question. So the gentleman in the third row.
Thank you for taking my question. Fan Cho from Bank of America. So 3 questions. First one is following Mr. Loy's earlier comment on the high-end residential project like Victoria Harbour. As you know that the mainland macro is still pretty uncertain, do you really feel that a couple of U.S. rate cut will be really that positive to the high-end luxury demand? And based on your sales strategy, will you consider focusing a little bit more on asset churn rather than margin maximization? Second, also on Resi, on your upcoming Sai Sha project, obviously huge in size and in a relatively new area as well. So what type of buyers are we targeting, and what is the sales strategy and margin outlook be like? Lastly, on mainland retail, could you quantify a little bit the positive reversion that we achieve in FY24? And given the luxury sales is pretty lackluster this year, any risk of turning into negative reversion next year? And in particular, if you can comment a little bit on the tenant sale of Shanghai IFC Mall, as well as the leasing demand, that would be great. Thank you.
Yes, as I have mentioned, I think the luxury sector will be doing well in the next 12 months, as we have seen a lot of luxury buyers are coming back. And of course, recently we have sold a number of units in Dynasty Court, having a price tag of 50 to 100 million per unit. I think most of these buyers, whether locals or non-locals, they need more time to arrange their financing, but we can provide them very flexible payment terms and expect to record the sales later, or maybe some 9 months, 10 months later. But the sales can change easily when we are providing flexible payment terms. On the Sai Sha project, it is a very unique project, blending with great nature and beautiful environment, and attaching to comprehensive sports facilities provided by the Go Park and the Water Park, and also living amenities with wellness and health, and also a very convenient traffic link. It only takes a few minutes drive to Wu Kai Sha and University, MTR station. Over the years, we have extensive experience to develop, to build and manage large-scale development like the Park Island in Bawan 2 decades ago, and in recent years, that is the Yoho series, including the Park Yoho and also the wetland project series. Both of them are carrying a few thousand units. And lately, the Lowland project comprising over 4,500 units, of which we have sold over 70% already. And for the Saisa project, we are going to build and market according to an orderly pace and according to the current market condition. For phase 1A of the project, only carrying 800 units, we are going to market in early next year, and we are very confident that it will be well received. Thank you.
For the mainland retail market, in terms of our rental portfolio for the financial year, last financial year has achieved a strong positive growth, I think double-digit in RMB terms. And the reversion is also positive in the double-digit regions. Of course, there's as you read in the news, market has seen a slowdown in the second quarter of 2024, mostly, we believe, due to the gradual and normal process of the border opening. But at the same time, I think we recently saw that the yen has come back up, so that probably will normalize over time. And we also continue to stay in very close touch with the luxury brands. They are cautious, but I think similar to the office market in Hong Kong, they choose the best quality projects to expand. So take our Shanghai IFC, for example. We are kind of in serious discussions with some of our major luxury tenants to further expand their global flagship stores in that mall. And so we are in the process of concluding some deals and redesigning some parts of the mall. And we believe that will, upon completion, right, that will be able to push the Shanghai IFC to a higher level, right? And as I mentioned just now, the recent opening of Nanjing IFC has been, I think we can qualify as a success. And it's first is a reflection of the trust we have built with luxury brands. Second of all is also to the team's execution capability. So we believe that these can help us ride through this more challenging period. Thank you.
Thanks very much. So this is the end of today's briefing. Thanks all for coming despite the weather. So we have some refreshments, but so have a safe trip home. Thank you.